Let's take a wider look on markets. TD Ameritrade out with its investor movement index, showing traders took a more risk-off approach in September. For more about what these results mean and what's driving the trends, let's bring in Shawn Cruz, TD Ameritrade head trading strategist. Shawn, these notes are always really interesting to me, a very good gauge of where the retail investor stands. Feels like it's pretty much tracking with the rest of the market. Things just aren't feeling very good.
Yeah, I think right now we got a little bit of a head fake back in August. There was actually recovery. For the first time this year, we actually had that investor movement index tick higher. And I think that quickly got wiped off the table in September. So what we did see in what clients were buying, they were certainly being a little bit more conservative in that they weren't going out there buying some of the more speculative areas of the market, some of the more speculative names that maybe aren't profitable right now, or just have some very high multiples. They're not really reaching for those right now. They're going back to some of the more familiar, established names out there. In some cases, really looking at names with quality fundamentals, be that solid revenues, solid cash flow, healthy balance sheets. Leverage was another thing that they certainly have been a little bit wary of as we're starting to see rates tick higher and higher. That is going to impact some of those more highly levered companies versus the more fundamentally sound companies. So they still found some opportunities out there, but they certainly are a little bit cautious right now, and I think that makes sense.
And we're going to get to some of those names we just showed on the screen there, but broadly speaking, what has led to the sell-off that you have seen, exiting of positions? Is it really just about the Fed?
I think that really was what drove that optimism in August, and that light at the end of the tunnel from the Fed pausing or potentially even reversing some of those rate hikes drove a lot of optimism, but like I said, that light at the end of the tunnel ended up being a train coming your way instead, and that really drove that shift in sentiment. In that, not only were we getting some data that did indicate they haven't made significant progress. They are starting to have an effect. Look at housing, for instance. But the Fed kept coming out. Whenever the market would give a little bit of a pop of optimism, you would almost have a Fed speaker, someone somewhere come out and say, look, we're not stopping. This is something we are committed to. I think they're coming around to that notion, and that's why we're trading down at these levels. I think the market's going to respond differently to maybe a hawkish Fed when we're trading at 3,600 on the S&P 500 versus, say, trading up at 4,000 or 4,200. So I do think a lot of that is now priced in. If things get significantly worse, and that's why we just spoke about the bank earnings, that is going to be huge. The macro read-through on what we hear from the banks, I think, is really going to set the tone for the rest of earnings seasons. And I think the market is also going to change their macro outlook based on what we hear.
So let's talk about some of those names that we have seen big moves in. In terms of net buyers, we're seeing a lot of the chip makers. You could argue that's part of a valuation play, given just how far some of these names have pulled back. But in terms of those that are being sold, ExxonMobil and BP, an interesting one to me because energy has been pretty strong. Is this sort of the expectation that we have reached the peak with some of these names and the pullback is coming?
That is where we see that type of activity. I don't think anyone expects crude oil to completely fall apart anytime soon, but I do think they're looking at it from a little bit more of a valuation standpoint. And we've seen that where you get these energy companies trading towards the bottom of their range. That's where there's a lot of interest in buying. When they recover and they start heading towards the upper end of those ranges, that's where they rotate out of those. So I think it's an interesting strategy. It's more of a short-term strategy I think we see playing out, but they use those profits when they do decide to roll out and lower exposure in those names. We actually do see them going out there and trying to find opportunity elsewhere. And semiconductors last month was that key spot. I think we saw a lot of interest on the buy side. Certainly today, I think, caught a lot of people off guard. If you look at the semiconductors that are really getting hit, it's the semiconductor companies that really have a lot of exposure to that relationship with China and just what goes on in the onshore-offshore aspect of their supply chains. But I think what they were looking at, if you look at the charts, AMD, NVIDIA, Intel, all those names were hitting these support levels. And when you see these support levels, these ranges, they start to approach the lower end. That's where you get a lot of buying activity. I'm going to venture guess when we look at this again next month, we're going to see a lot of selling as they broke through some of those.
I was going to say, I wonder if some of that buying holds, especially as we get these warnings about demand, especially from a lot of these big chip makers. TSMC, another one we're expected to hear from this week. Shawn Cruz at TD Ameritrade, hedge trading strategist. Thanks so much for joining us today.